Hi, welcome back to another edition of Lipper's Fund Flows Insight. My name is Tom Rosine. Thanks for joining me today. I'm going to be reporting flows for the weekend of Wednesday, November 5th, 2014. Mutual fund investors injected about $8.5 billion into the conventional fund business. That's actually ETFs. And we'll be talking a little bit later on ETF flows as well, but this is just to get a view of what's been happening in the mutual fund industry. Basically, for the third consecutive week, we've seen inflows. And this week was kind of a little bit different as far as the week goes. We had a very strong performance. We saw another new record, so that's not all that new. We saw the Dow climb to about 17,484 on Wednesday, closing the business, but it was kind of the way it happened. We had pretty strong earnings reports that came out and on Friday, and that was kind of good news. And then Monday, Tuesday came about, and I think it was flat to down a little bit. But on Wednesday, actually, we had some interesting news. 2 points. First of all, we had the midterm elections that came around and basically voted in a Republican party as far as the House goes, and people think that could be more business friendly, so that was a big plus. But I think the biggest news was really on Friday when the Bank of Japan actually announced that it was going to do some big quantitative easing to help retool, if you will, their economy, get the inflation back in there. They had deflation for such a long period of time, they wanted to get asset inflation going on. And I think people responded very well to that news. And then last, on this Wednesday as well, we heard the ADP numbers come in, and they said they saw the private labor market, the private sector market, actually add about 230,000 net new jobs for the month of October, and that was very strong news. And that really started the ball rolling, on Wednesday, and really got things cooking. So we had a really good day on Friday and Thursday, and then we had a really good day on Wednesday, and we saw some pretty strong flows, about $8.5 billion net new money coming to the group. Let's see how that panned out into our macro groups. Take a look at equity funds. They took in about only $300 million. And then we saw kind of a dichotomy here. We'll talk about this as we go on, but taxable bond funds took in $5.6 billion. So there was a risk on in bond funds, but a risk off in equities, and that's kind of a head scratcher. Muni bond funds, about $60 million in net new money coming to their coffers. Again, that could be a rounding error as far as that's concerned. So, but they actually on the plus side, we saw 2 weeks prior that they actually were losing money, so that was actually on the plus side. And money market funds saw about $2.5 billion of money enter their coffers as well. Well, let's see how this panned out in the equity arena to see actually what happened. I'll give you a little bit more of that story. But, equity funds were up about 1.49%, third consecutive week that we've seen plus side returns, and again, only $300 million in net new money coming to the coffers. That's really strange. Second and third week, though, that we saw plus side flows. But how this broke out, domestic equity funds actually saw $1 billion in outflow in the second consecutive week that we've seen outflows. And then if you take a look at non-domestic equity funds, they took in $1.3 billion. And this is after learning about the news that Germany was actually on a slower growth path, that the European group, that the European Union was basically having slowing growth. We heard Draghi come out and say that instead of having a little bit under 1%, I think it was like 0.3% growth rate. So really, this is kind of a head scratcher that we'd have that type of thing. If we take a look at how it broke out, though, on the domestic side, we did see outflows out of all three groups: small, mid, and large. But mid took the big chunk. Took about $600 million of money coming out of the flows. And if we saw the small and the large caps, they lost about around $300 million each. So that was part of the story. Interesting enough, though, global instead of international equities took in the money. So we saw international funds actually have outflows, but global equity funds had $1.6 billion of inflows. So again, another head scratcher. That means they were investing in the United States and globally to get that. And then the last piece that was a little bit of head scratcher, emerging market funds actually took in about $300 million. So it was just a confusing week overall. Well, let's add to that confusion by looking at the ETF flows that we saw. For the second consecutive week, we saw big inflows, $15.1 billion. And how it panned out is basically the Spider S&P 500 saw about $7.1 billion, very similar to last week. But here is where it kind of changes. We saw the Power Shares QQQ taking about 2.2. And we keep going down with the Russell taking in about $2 billion as well. So these big name groups took in huge amounts of money while people were leaving the conventional fund business from domestic equity. So a little bit of head scratcher there. And on the downside, what we saw, and this is actually relates to when we saw some of the worries come out, is that we've seen a big slide in oil and also materials, with the cooling economy in China. So it's not surprising to see the materials select sector equity Spider Fund actually lose the biggest amount of money, $0.8 billion in outflows. And then we saw iShares U.S. real estate ETF also lose about $500 million. So that was not that big of a story as far as on the downside. We kind of expected those type of moves. Well, here's where the surprising piece steps in, and that's when we take a look at the fixed income universe. Fixed income universe saw for the 13th consecutive week inflows, and this week we saw $5.6 billion come into their coffers, and it's the third consecutive week we've seen plus side returns, only to the tune of about 0.29, so 0.29%. But again, it was on the plus side. And how this panned out is we had corporate investment grade debt funds that took in about $2.6 billion, 27th consecutive week we've seen inflows into that group. And then here's where the risk on play actually took a hold. High yield funds took in about $2.3 billion, a third consecutive week. So here we have people taking off risk on the equity side, taking on risk on the fixed income side, even after the Fed came out last week and said that in fact their easing is over. And in fact, we even heard this week, while part of the Fed was in some of their talks, basically saying that there's a good likelihood that we might see interest rates rising sometime soon. So again, a little bit of a head scratcher. Now, if we take a look at loan participation funds, though, we saw that even though they're talking about increase in interest rates, that certainly that 1% floor of a lot of the loan pars came into effect. And we saw about $300 million in outflows out of that group. It's the 17th consecutive week we've seen outflows from that group. Let's take a quick look now at the ETFs and how that panned out. ETFs, about $700 million of net new money coming to their group. This is about the fifth consecutive week that we've actually seen net new flows. But if we take a look at it, iShares short Treasury bond ETF, again, this is the second week in a row that it's been a big producer as far as attracting money, $1.6 billion in, and iShares 1 to 3 Treasury bond ETF saw about $1.3 billion out. Wasn't a big story as far as ETF goes in the fixed income universe, but certainly a head scratcher when we start comparing the fixed income to the retail side of the fixed income to the retail side of equity funds. Well, let's go now to muni bond funds. As I told you, we saw about $600 million of money come into their coffers. It's the first week in 3 we actually seen inflows. It's the third consecutive week that we've had negative returns, but this time only 0.08 as far as negative returns go, so not much. National munis actually took in $110 million, so that tells us single states actually saw some pretty big outflows. And this is the second consecutive week that we've seen munis, national munis, take in money again and pile money back into it. So people are taking a chance in going back into the munis and looking for that after-tax return. And that kind of makes sense as we getting closer to the end of the year as well. Let's take a look at money market funds. Now, money market funds for the third consecutive week saw inflows, this time $2.5 billion. And how it panned out is we saw taxable money market funds taking about $1.6 billion and tax-exempt money market funds take in about $0.9 or $900 million. But really the interesting point is institutional investors actually padding the coffers of money market funds, $3.2 billion, versus the retail investor actually pulling about $1.6 billion out of the money market arena. So now that kind of brings us to the end, and I think what it is we're going to be taking a look at what goes on the rest of the week. This morning we actually had some good news in that we saw an increase in our number of people hired. Non-farm payrolls came in about 214,000. I was off, though, from the 235,000 that people had expected, and the market actually responded in kind. We've actually are right now getting probably about 10 minutes away from close, and we're still in the negative numbers for the Dow and the S&P. Not big, but we are seeing a rally in gold. So this will be kind of something for us to take a look at. The unemployment rate dropped to 5.8%, so there are some good things about this, but again, people I think are a little bit concerned of the how long this rally has been going on, and they are starting to get the idea that it's been a little long in the tooth, even though there are many pundits out there that says we are on another rally for the next 3 to 4 or 5 months even. So we'll have to see if that pans out. Well, if you didn't get all the information that you needed out of this video, you can certainly go to our website at www.lipperusfundflows.com. If not, you can join us next week when one of our analysts will talk to you about the fund flows for the week. Until next time, my name is Tom Rosine, wishing you the best in your wealth planning and creation. Thanks for joining me.